In this session, let's look out for the various aspects of portfolio performance evaluation, the various measures associated with the portfolio performance, because we talk about something called Sharpe ratio, a trainer ratio. So these are some of the things which we have been talking about on various occasions. So just as a collated piece, how do I evaluate the portfolio's performance, and a little bit more aspects in terms of how do I look at the statistical significance of that, and a few more aspects relating to the portfolio performance evaluation. So before we understand the various measures associated with a portfolio, I would like to look out for the key difference existing between a dollar weighted returns. Whenever we talk about a return on the portfolio, what is that return I should look out for? There are two major categories of returns. One is a dollar weighted, or sometimes we even call as money weighted. So a dollar weighted return, or even a time weighted return. So dollar weighted return is as simple as the IRR, the internal rate of return associated with the portfolio. So it is depending on when the cash flows are occurring, right? Based on the cash flows during each of the period, inflows and outflows taken together, and found out that particular rate of return where the net present value is zero. Probably the better way to understand it is through a simple example. Let's say today, I'll create a small example. Today, buy 2 shares at $50 per share, right? Then 1 year later, or probably 2 years back. So this is not today, let's say 2 years back. Buy 2 shares at $50 per share. 1 year later from this, means 1 year back, buy 3 shares at $60 per share. And probably during this 1 year, there was a dividend, let's say, of $2 per share. And let's say today, sell 5 shares at $75 per share, but in the meanwhile receive a $3 per share dividend. So here there are two occasions where so when I go with a dollar weighted return, I am seeing in each of the periods what was the net cash flow. So 2 years back, 1 year back, and today. Means probably when I am looking at 2 years back, the investment was $100. Right? The investment was $100 because 2 shares have been purchased. Whereas after 1 year, okay, 3 more shares were purchased at 60, so $180 is the cash outflow. But along with that, because a dividend of $2 per share, so whichever the shares that were held in the previous period, a dividend of $2 per share would have received. So your net cash outflow in the second year has been only $176 because of this. So the initial year the cash outflow is 100, in the next year the cash outflow is 176, and the year next, which is today, $75 a share for 5 shares. So there is a $375 cash inflow along with a $3 per share. You have 5 shares. So 15 more dollars is the cash inflow, overall resulting in $390. So probably all you can take is your cash flows minus 100 in the first year, minus 176 in the second year, and 390 now. So the IRR of this entire thing is around 28%. So this 28% from this example is what we call as dollar weighted, which means the cash flows, we are trying to find the present value of all the cash flows, and using that particular rate of return where the present value of the cash inflows is equal to the present value of the cash outflows. In a way, the NPV is zero. That kind of a return we call as the money weighted return or a dollar weighted return. So different cash flows, all cash flows at each of the positions, I bring either to the present value and equate the NPV to zero, or even I can take all of them to the future value and say the future value of the cash inflows should be equal to the future value of the cash outflows, either way. So in a way it is nothing but the IRR of the portfolio. Whereas when I say time weighted, my intention is to look out for separate time intervals. Okay, here I have purchased 100, but before I purchased anything during, so this is the time when actually another cash flow has come for some $180 to purchase 3 shares. So just before this new cash flow came in, this is the way we find time weighted return. Just before the new cash flow flew in, whatever was the investment that was done, what was the value of it? So this 100 has actually become how much? Because the share has become $60 per share, this 100 would have become 120 by this time. And along with that, a dividend of 2 per share has come. So overall 124 is what these shares have actually become. So I'm trying to find out what is the return there. 124 divided by 100. So almost 24% was the return in the first year. Now similarly, okay, now that this amount is 124, and to that 124, 180 got added. So overall the amount that was existing is 304 now. And this 304 was the value at the beginning of the second year, and by the end of the next year it has become 390. So I can try to find out what was the return during this phase. 390 minus 304 divided by 304. So for that period it is somewhere around 28.2%. In the first period it's somewhere around 24. So I can take the geometric mean between the two and talk about 26% being the return, 26.06% being the time weighted rate of return during this period. So the time weighted rate of return is 26.06, which is the geometric mean between the geometric mean of all holding period returns. What do we mean by that all holding period return? Before there is any cash flow change, inflow or outflow, I will try to find the returns for those periods just before any new cash flow got added or the existing cash flow got pulled out, just before that time, what was the worth of the existing portfolio? What is the returns that the existing portfolio has given? And based on that, I'm trying to find out what is the holding period returns for each of the periods, and I will be taking the geometric mean for all those holding period return and say that this is the time weighted rate of return. In fact, the better way to position this time weighted rate of return is 1 plus this multiplied by 1 plus this. Just put the entire thing under square root. Put this entire thing under square root. Right? Make all the returns 1 plus. Find the square root there, then subtract 1. So actually the better number is 26.13 rather than 26.06. So this is the time weighted rate of return. Now the question arises, will this time weighted rate of return always be lesser than the money weighted? No. Especially when I see the timing of the cash that got added. Right? This is the time in which the cash got added. Now, if the portfolio, if the security perform really extraordinary during this period, then time weight of return will be much higher. Right? So more funds added before a period of poor performance. In that case, the dollar weighted rate of return is greater than time weighted. But if more funds are added, during the period of higher return, you will see that the dollar weighted rate of return is lesser than the time weighted rate of return. So it depends on when the funds are added. If they are added before a period of high performance, then the time weighted rate of return will be much higher. But if they are added before a period of poor performance, then the dollar weighted rate of return will be much higher. And because the manager of a fund does not have the control on the amount or timing of the cash flow, because you don't know when people will invest into a fund and when people will redeem the units of their fund. So manager does not really have any control on the timing or the amount of cash flows. That is one of the prime reasons people, especially in the portfolio management industry, we try to evaluate the performance of the fund managers using the time weighted rate of return itself. Whatever was the cash that was available to the manager, how much was the return he is able to generate on that. That is the reason time weighted rate of return is much more apt compared to the dollar weighted return. Only in those kind of investments, especially the individual investors or high institutional investors where they trade for themselves, where they have a control on the timing and the amount of cash flows, there probably we could see the money weighted or dollar weighted rate of return as a benchmark. But where the cash flow control does not exist, it's better to look out for time weighted rated rate of return as the benchmark for measuring the performance. So it all even reflects the ability of the manager to select the right investments at the right time. This much capital I have today. Which securities or which asset classes need to be selected for the investment purpose? That is what is clearly reflected as a part of the time weighted rate of return for the manager. So if a manager is having a very good market timing ability, it will be reflected in the dollar weight of rate of return exceeding the time weighted rate of return by a decent extent. So now that we know that in this case the time weighted rate of return is one of the important or one of the better mechanisms for measuring the performance of the manager, we will try to see what various measures are associated which could be used for comparing the performances. Generally, we talk about so many names. We have seen a lot of names earlier. Also, we got exposed to these terms earlier also in various occasions. But generally, whenever we try to measure the performance of a portfolio, we just don't look at only the returns, but in most of the cases, we do risk adjusted returns, right? So, but the more, one of the common scenarios probably is before we look at the risk adjusted, one way of performance measurement is the universe comparison mechanism, wherein we look at all the funds, right? All the funds with similar investment styles, probably all large cap funds, all growth funds, so with similar investment style, all the funds of various companies, all the funds that are prompted which are having similar investment characteristics and similar risk characteristics, they are grouped together. So once they are grouped, within the group, I'll just look at the returns. I'll just rank the companies based on the returns because I'm assuming there that all the companies, all the funds within that group have the same investment characteristics. But if that assumption is violated, then just comparison of the returns will be a big blunder. So it may not be effective, especially within the group. You find the risk profiles of different funds completely different, only applicable until the risk characteristics are more or less similar across all the funds. Then the other thing we are looking at is from a measures perspective, we are looking at Sharpe ratio, which is simply treated as the return on portfolio minus the risk-free rate of return divided by the standard deviation of the portfolio. Right? Let's say in this example, these are the returns. These are the various returns I had probably on a monthly basis over the last 13 months. Right? So here the average return, let me take average actual return on the portfolio is equal to, I'm taking the average return of the portfolio. Let's say it's around 2.27%, works out to be the average annual return on the portfolio, and probably this is the monthly return. That's okay. We'll take this as annual itself. So average annual return, I'm assuming that these are all annualized kind of numbers. So if the average actual return is 2.27, and probably if I say the risk-free, the risk-free rate of return is 1% or 1.5%. I'm assuming that the risk-free rate of return is 1.5%. Then I'm also taking the standard deviation of the portfolio. So standard deviation of the returns coming out to, this is the standard deviation of the return, somewhere around 7.3% happens to be the standard deviation of the returns. So from here I can compute the Sharpe ratio as risk-free rate of the average portfolio return minus the risk-free rate of return divided by the standard deviation of the return. So the Sharpe ratio is somewhere around 0.104. Now the higher it is, the better it is, right? When I am comparing two portfolios on this risk adjusted return basis, the higher it is, the better it is, right? And one more thing is, this actually captures the total risk involved in the portfolio. So it even includes the systematic as well as the unsystematic, right? So it does not assume that your portfolio is well diversified. If it is well diversified kind of a portfolio, probably this only exists, this does not have any kind of a relevance. Whereas if my portfolio does not is not well diversified, then even this contributes to the total risk. So the Sharpe ratio is a measure of both systematic as well as the unsystematic risk based performance of the portfolio. So on the other side, we also have a mechanism which deals only with the systematic risk, assuming that the portfolio is well diversified. If the portfolio is well diversified, then probably whatever the ranking that is provided by the Sharpe ratio and the trainer ratio, both of them will be the same, because as per trainer ratio, the formula is portfolio's return minus the risk-free rate of return divided by the average beta, right? So in this case, probably I can find out average beta of the security or the portfolio. When I take the average beta of the portfolio, it's somewhere around 1.02. So from here I can find out the trainer ratio as portfolio return minus the risk-free rate of return divided by the average beta during the period. So the trainer is working out to 0.007. The higher it is, the better it is. And as we all know, beta is nothing but it is the regression coefficient. When I regress the securities returns over the market returns, whatever is the coefficient of that market returns is what we attribute to beta. And in a way, it's a measure of systematic risk. So it clearly assumes that our portfolio is well diversified, which means the diversifiable or unsystematic kind of a risk is zero in that case, and only systematic risk exists. So that's where, if at all we see that the ranking of the portfolios based on Sharpe and trainer ratio being the same indicate that the portfolio is well diversified, but the higher the differences shown between the Sharpe and the trainer, it indicates that the portfolio is not well diversified. So in a way, to comment on the diversification nature of the portfolio, we can very well take both the Sharpe and trainer ratio together to evaluate the performance. Then the other thing is the Jensen's alpha. Here we are talking about the actual return on the portfolio minus expected return on the portfolio. And the expected return comes from some kind of risk assessment kind of model. The most common one, let's say being the capital asset pricing model, where we are talking about the actual portfolio performance minus risk adjusted, risk free rate of return plus the beta times RM minus RF. This is what is the CAPM based expected rate of return kind of a formula. So the actual return minus this is what we call as alpha. So in this case, probably if I want to look at this alpha, I'll take actual return minus of risk free rate of return is this much plus beta times RM minus RF. This is the market return minus the risk free rate of return. So here the alpha is around 2.15% positive. So we could see the alpha in some cases is very much positive, in some cases negative. The positive the alpha is, the fund or the fund manager has performed much better during that process. Right, the higher the alpha of the fund, the positive and higher the alpha of the fund is, it's a measure of better performance of that particular fund. The more negative it is, it it could not generate the return that is really expected. But of course, just like a trainer, even this also looks only at the systematic risk. It also observes that the portfolio is well diversified, because the expected rate of return is computed using the CAPM formula, and the CAPM formula considers only the systematic risk. So even the Jensen's alpha considers only the systematic risk like the trainer, whereas the Sharpe measure looks at both the systematic risk as well as the unsystematic diversifiable kind of a risk. So the alpha is changing for each of the periods. Positive is an indication of a good performance. Negative is an indication of a poor performance. So that's how we look at the alpha, and I can compute this alpha separately for each of the time periods, right? Then a few more ratios to look at here. Okay, now that I got my alpha here, but a better adjustment to that is what we call as information ratio. Here, either I can compute whatever the alpha I have got like this. I take the standard deviation of alpha, right? We have two different variations here. Let me talk about them. I take the standard deviation of alpha, so which is something around that much, whereas I take the average alpha. The average of these numbers, the average alpha, which is the average of these numbers, I take the average alpha and divide it by the standard deviation of the alpha to get information ratio. Information ratio is nothing but average alpha divided by the standard deviation of the alpha. So again, this is also a risk adjusted kind of a measure. So which means the higher the better it is. But apart from, see, the alpha here, whatever we have found out is purely based on the CAPM model. The expected return is based on the CAPM model. But here I can use the alpha as any benchmark also. So if I assume that this is my benchmark number, some index or something which I am taking as my benchmark, The difference between the actual return and the benchmark return also is defined as alpha itself. The excess of actual return over a benchmark return also we are treating as alpha only. So when we talk about alpha, we should be very clear about against which we are trying to compare, right? Probably when I use a broad definition of Jensen alpha, then my intention is to look out only for CAPM based return and the actual return in excess to that. But when I in general scenario when I am using, right, then I can look at it as the difference between the actual returns and any benchmark return. So probably if I assume this is some index related return, the difference between the two is what is a measure of alpha here. So from this also I can find out average alpha. Let me call it as average alpha 1 for our understanding. So this is the average alpha 1 and probably standard deviation of alpha 1. Standard deviation of alpha 1 comes out to be this much. So from here I can find out the information ratio 1, which is nothing but average divided by the standard deviation. So this is what comes out to be the information ratio. Now whatever I am using, whatever the benchmark I am using, and looking out for the value of information ratio, the higher the ratio the better it is. Again, the focus here for us is because I am taking the whatever I am taking the benchmark, I don't know what could have gone as a part of this benchmark. Is it only the market risk or systematic risk, or it includes unsystematic also? We have to really understand that. So we cannot directly say that this is just a measure of systematic or includes both systematic as well as unsystematic risk. But the simple thing is, otherwise called as appraisal ratio, the higher the better it is. And apart from that, one very recent or probably a 20 to 30 years back entry into this portfolio performance measures is M squared. Don't get misunderstood as something like a square of a number which should be positive. This is not the meaning of M squared here. The meaning is actually it is found by it is named out of the founders or whosoever have come out, Modigliani and Modigliani, grandfather and granddaughter. So these two people came out with this particular measure, and that's where the M squared is the name given to it. A straightforward measure. You take the portfolio return. So basically it's like you adjust the portfolio standard deviation so that it matches the market standard deviation. What I mean by that is, in this data we have seen that the portfolio standard deviation is this much. Now if I take the market standard deviation, how much is it? I can find out the market standard deviation also, and this is what is the market, this is what is the market standard deviation, around 7.7. Now make the standard deviation of the security equal to the market standard deviation. So what does that mean? You invest some some X% in the security and the remaining 1 minus X% in the risk free, so that the overall standard deviation will match that of the market, right? So because the standard deviation of a risk-free security is 0, it is nothing but the weight that you have to give in this security is nothing but the ratio of the market standard deviation to the security standard deviation. So weightage that you have to give to the security is the market standard deviation divided by the security standard deviation. Almost 105% is what you have to invest in the security, and the risk free you have to, so the risk free investment we are talking about the 1 minus of this, so somewhere around minus 5.45%. Now, assuming this kind of investments, you try to find out the adjusted return of the portfolio. Adjusted return of portfolio using this mechanism. So this much is invested in risk-free asset, so you'll get risk-free rate of return, and this much is invested in the risky asset, which will give you this much of return. So the adjusted return of portfolio for us is going to be around 2.31%. This is the adjusted return on the portfolio using this mechanism, and based on this I can even find out the market return. So average market return. So both of them now, the market as well as our security, both of them have the same standard deviation. So taking this, okay, the market has given 2.269% return. So from here I can compute M squared. In this case is adjusted portfolio return. I am making an adjustment in such a way that the return of the portfolio will come out to be the same as the return, the risk of the portfolio, the standard deviation of the portfolio will come out to be the same as the standard deviation of the market. And once they are equal, find out the adjusted rate of return on the portfolio, subtract the market return to arrive at the M squared. So in this case, at least the M squared is positive, which means the portfolio has generated a slightly better performance than the market. This is a very, and in this M squared we can even see negative number also, because this is not that traditional traditional square of some number. It is just a name behind the people who have come out with this particular formula. So the positive it is, the portfolio has performed better. The more negative it is, the portfolio's performance is not that exciting. So you are computing the modified return with the new allocation, and then we are trying to find out the difference to finally arrive at an M squared and interpret the performance being good if positive, not so good if it is negative. And here also we see this is also taking the standard deviation. So which means this measure also is considering the total deviation or the total risk, not just the systematic. So so it's more and more similar to your Sharpe ratio, which considers both systematic as well as the unsystematic risk. Whereas when we are talking about trainer and alpha, they give more or less similar kind of conclusions, because they deal only with the systematic risk. And if the portfolio is not well diversified, then we may see different kinds of conclusions coming out between the Sharpe ratio and the trainer ratio, or between M squared and the trainer ratio, and something like that. So probably on a broader scale, you can group the Sharpe ratio as well as M squared as measures of the total risk, whereas the trainer and alpha being the measures of the systematic risk of the portfolio itself, right? So these are the various mechanisms we need to be comfortable with if we are trying to measure the performance of our portfolio, right? Then the next thing that is worth looking at is, okay, we have determined the alpha file, but what is the statistical significance associated with the alpha? Can I say that alpha is 0, or is it significantly greater than or less than 0? Now that in this example also we have got, probably let's say I go with this mechanism, alpha I got it as 0.1, or when I am using this, I got this alpha as around 1.81. Now all we are saying is, can I say that the alpha is significant? Means the returns that the manager has generated, they are really significant, they are really consistent, whether it is, so the positive alpha that has come out, is it more significant and consistent, or is it just by fluke? For that purpose we are using a t-test for the alpha, wherein we simply do the alpha, we calculate whatever is the alpha or the average alpha that we got, we divide it by the standard error of alpha. And how do I get the standard error of alpha? It's nothing but the standard deviation of alpha divided by square root of n. So in this case, okay, standard error of alpha. In the first case, standard deviation of alpha divided by square root of 13, because we had 13 data points. So this happens to be the standard error of alpha. And in the second case, standard error of alpha 1 when I am talking about, then the standard deviation of alpha 1 divided by the square root of 13. So these are the two numbers that came out, and from here I can even find out the t statistic. So the t statistic of alpha, which is nothing but the alpha value divided by the standard error of alpha. So this happens to be the t, and similarly the t statistic of alpha 1 is coming out as alpha 1 divided by the standard error of alpha 1. Now this is what is an interesting case. Now if I look at this t statistic, I'll compare it with somewhere around with the number 2. The reason being 95% confidence level. So when I talk about 95% confidence level, generally if I assume the distribution to be normal, the calculated statistic should lie between 1 minus 1.96 to 1.96, and that too if I assume t distribution to be a slightly fatter tail distribution, I look at it to be lying between minus 2 and plus 2. And I'm not that much bothered about the negative side, because a negative alpha, I'm not that, it's as good as a failure itself. So I'm only looking at the positive side of it. That's where I'll see if the alpha is greater than 2. I'll say it is significant. Otherwise, so the simple test is whatever the t statistic, the t value greater than 2, it means alpha is significant. Otherwise, we cannot have any kind of an evidence to say that the alpha is significant. So I can very well go with the alpha being as good as 0 itself. So when I am comparing this alpha with respect to a benchmark, I was able to generate a t-value which is greater than 2, but when I am trying to look out in the computation of alpha with respect to the CAPM, then I am not able to generate a return that is more and more consistent, because the t-value is just 0.12, which is lesser than 2 itself. So that is how we test whether the alpha that we got, whether it is the positive alpha, whatever we have got, is really significant and consistent, is what is tested through that t-test mechanism, right? So we talk about all these measures: Sharpe ratio, trainer ratio, M squared, alpha, information ratio, all these things. But all these are applicable to traditional securities, traditional portfolios, where the underlying securities come from the traditional investments like stocks, bonds, etc. But when it comes to the hedge fund, regular mutual funds can very well be measured quite comfortably using that alpha, Sharpe ratio, trainer ratio, etc. But when it comes to hedge funds, using that performance analysis mechanisms is very difficult. Because one thing, the main intention of a hedge fund itself is to generate a positive alpha. Hedging, using the hedge mechanism, create a return. So the intention in general for any hedge fund is create a positive return with zero risk. Create an alpha, create a positive alpha with probably zero beta or zero risk associated. So there is in this, the risk is not that linear, and it keeps changing with time, because the hedge fund manager has a lot of flexibility in terms of switching the assets, in terms of using any securities like derivatives or short positions and all these things. So the risk that is involved in this hedge fund investment is non-linear, and most of the time the regular measures like Sharpe and trainer, we see that the graphs associated with them are more and more linear. So they are more applicable for linear risks, but for non-linear risks which are present in hedge fund, we see that the regular performance measures may not be a good tool at all. And we also see that because the hedge funds are not that regulated, the reporting and disclosure aspects are not that transparent. We see that the managers generally provide the smoothened reports, because everything, the data, reports, they are all supplied by the manager, and based on whatever the fund manager has supplied, they would be used for analysis. So there could be subjecting to lots of biases, and at the same time we see hedge funds, there is a high liquidity also associated with them, which can result in heavy amount of serial correlation present in the data. And most of the measures that we are talking of, they are not efficient when there is an auto serial correlation that is present in the data, because they assume that the return of the period n is hardly dependent on the returns of the period n minus 1. The other major problem is because of widely varying kind of strategies available with hedge fund, we see that their correlation with the traditional investments like stocks, bonds, mutual funds, etc., the correlation with respect to those traditional investments is lower in a growing economy and offer a better diversification, but in case of falling economy, they do not offer any kind of a diversification because the correlation with the traditional investments actually goes higher for them. So in a way, even in falling market, they are not offering any kind of a better hedge, and that too because the correlation keeps changing. Dynamics keep changing every period, measuring the risk and the performance, adjusting for all these dynamic changes is very difficult with respect to hedge fund. And at the end, whenever we are talking about the alpha with respect to hedge fund, it's not based on the market. Sometimes people talk about this like hedge fund is something which should be able to generate positive alpha irrespective of the market. See, normal behavior is when the market is not doing well, even my security or the fund also does not do well. But that is an exception with respect to the expectation from the hedge fund. As per the expectations of the hedge fund goes, whether the market is doing well or not, the hedge fund should generate a positive alpha because the hedge fund manager can use his or her own mechanisms to enter into short or long positions depending on how the market is moving and try to extract the arbitrage positions out of arbitrage profits out of the positions that are taken. And majorly the hedge fund managers get into long short positions working out on the arbitrage part. So depending on how the market is moving, so you can club this concept of hedge fund with almost any kind of a market, any kind of securities, because the entire model is based on generating an arbitrage profit by identifying the mispricings of the securities in various markets. And some of the important points to consider in this context, if at all the portfolio is changing quite drastically like the hedge funds or probably even in a regular scenario also, if the portfolio's risk levels are changing quite drastically, then it's better not to go ahead with the Sharpe ratio. More and more similar levels of risk is what can very well be addressed by Sharpe ratios or for that matter any linear kind of ratios. But if we see that the performances or the risks of your underlying portfolio is drastically changing, probably from a standard deviation of 3%, next period the standard deviation has gone to 15% or something, and if you want to look out for the Sharpe ratio over a 2-year period, then it's not worth considering it. It may so happen that for each of the individual periods, let's say we are talking about a period where the standard deviation is around 3% and the next period the standard deviation somewhere is around 15%. What we could see is, it may so happen that the Sharpe ratio, if I look at only this period, may be a positive value, and a Sharpe ratio, or probably it may even exceed some kind of benchmark. Even here, when I am looking at the Sharpe ratio exclusively for this, it may be positive and it may be greater than a benchmark. But if I combine these two things and look at the overall Sharpe ratio and compare it with the benchmark, it may so happen that it may be lesser than the benchmark also. So that is where a suggestion is, if we are trying to mix the two different risk levels of the portfolio, it's better not to use Sharpe, because whenever the volatilities are very high within the portfolio, there are so many biases that get included and the conclusions that come out of the Sharpe ratio are pretty pathetic. So whenever we are trying to measure the performance of the portfolio, see what is the level of standard deviation or the fluctuation with respect to the standard deviation. change in the portfolio risk levels before really getting into using the Sharpe ratio for the assessment purpose. Alright. Then another important concept that comes in this space is how do I really measure the market timing ability of the fund manager. There are two mechanisms which are slightly interesting. See, we know that the portfolio return, the excess return, which is generated by the portfolio. We can actually model the market timing ability as a regression model, or we can model it as a call option model. We'll talk about both of them. When I'm talking about a regression model, I'm trying to regress the excess returns that are generated by my portfolio with respect to the excess return which market has generated, and by considering the beta. And at the same time, I'm also considering the D, which is a dummy variable, which will take a value of 0, probably like in say down market. If the market is down, I'll take that variable as 0, and if I'll take 1 in case of up market. The feeling here is when the market is doing good, we see that the fund managers, they actively invest, and when the market is bad, they go with a passive investment. So that is where we are trying to assign a variable D a value of 0 if the market is down and a value of 1 if the market is up. And we are trying to understand what is the difference between the up market beta and down market beta, which we are measuring as M. So in a way, if you try to look at this reframed equation, it becomes alpha plus Rm minus Rf times beta plus Md. So in case of down market, we see that D is 0. So we are talking only about beta, because we see that the portfolio managers follow more and more of passive investment during that time. But when the market is up, when D is 1, we try to measure the value of M so that the overall return is going as excess return is going as a factor of B plus M. And if M is highly positive, it means that the portfolio manager has utilized the market timing much better, and he has invested to get an excess positive return. So if this value generally goes high and high positive, we indicate that the timing ability of the manager is really good. Otherwise, the manager's timing ability is bad. But what we have seen is, even though when the market has done exceptionally well, or in an up market when D was 1, we have seen that the M value was negative also, which means the fund manager's timing ability was not that good. So that is one way we can really assess the timing abilities of the manager by modeling a regression mechanism with respect to the excess returns over the risk-free rate of return with respect to the timing ability of the manager. The second model is even more an interesting model, which we call as the call option based model. Simply look at it like this. When the market is really good, assume that any manager wants to invest 100% in the equity market only. The ideal or the worst the most extreme scenarios I'm talking of. If the market is rising, I want all my money to be invested in the equity market. If the market is falling, I want all my money to be invested in the risk-free or treasury bill market. So the same scenario if I want to create, the suggestion is if you are starting with an amount S naught. So you purchase T bills with this S naught. Let's say for a T period. So it is assured that your money will become S naught into 1 plus R to the power T. So at the end of T period, assuming R is, probably I'll take RF here. RF is the risk-free rate of return. So here S naught is becoming S naught into 1 plus RF to the power T at the end of T period. Now at the same time, purchase a call option on the same, on a security with a strike price equal to S naught into 1 plus RF to the power T and expiring in T period, right? And okay, you pay some kind of a premium, call option premium for that particular scenario. Now you assume that if the market price is greater than the strike price, the benefit that you are going to get is the difference between the market price and the strike price. And the same thing, because you have invested your money already in the T-bill, you are going to get the strike price as the money. So overall, whatever you have invested, you are going to get the market price out of it. Means the return, whatever you have invested, the return you are going to get is the market return only, which you could have got if you have invested 100% in the equity index. Similarly, if the market price was less than the strike price, then your call option would have gone expired. So what you would have got is only the strike price, which is nothing but your 100% investment in the T-bill. When the market is down, you wanted to invest your 100% in the treasury bills itself, and that is what you are getting with this model also. So you can very well create the market timing ability by just taking a call option. And of course, to get that particular thing, whatever is the premium you are paying, the call option premium you are paying, is your cost for using this market timing. The cost for using this market timing is the premium that is associated, because both of them, either doing this or doing this, both of them are going to result in the same payoff, except there is a premium that you are paying. So whatever we are calling as the value of the market timing is nothing but the price of the call option taken on the equity index and at the same time investing in the treasury bills. And the strike price associated with the call option is nothing but the future value that you are going to get out of the investment in the treasury bills. Then one more thing with respect to the portfolio performance is analyzing the style. This has been an important research study wherein a regression was performed for over a period of few years between the returns of the portfolio and the various indices, exhaustive, mutually exclusive indices. So they could be specific to a sector, they could be specific to to a broad country based index, they could be specific to equities, they could be specific to fixed incomes, any kind of indexes. Broad equity based indexes or broad indexes have been chosen. Within this also probably large market value or small high growth, any kind of style based indices. So we are trying to do a regression between the portfolio returns and the returns on the various indices relating to broad asset classes. Once this regression is performed, and also a small modification instead of the generalized regression is, it is made that these regression coefficients all put together, none of them is negative, and at the same time the summation of all these coefficients is set to 1, so that, or 100%, so that even these coefficients itself represent the weightages and also represents the allocation efficiency of the manager or allocation style, to which sector he has invested what proportion. That is what will come out as a part of the allocation style. So two things, apart from a regular regression, it's not a regular regression model. Apart from the regular regression, the two things are the coefficients of all those broad indices. They are chosen to be non-negative, and the sum of them equal to 100%. This is one major thing that has come, and out of that regression, whatever the R squared that has come up, it has been directly attributable to the various asset classes, means that performance is directly associated to asset allocation to proper asset classes. The allocation is coming out, and the rest of it is coming to selection of specific securities within the asset class. And what was observed is the R squared came out to almost 97.3% in that research model, wherein it was understood that 97.3 percentage of the fund's return was attributable to the asset classes, whereas so which means asset allocation, and only the remaining 2.7% was attributed to the perfect selection of securities within that asset class. So whenever we use the word asset allocation, we are typically looking at the returns on this particular benchmarks, on this particular model, minus the benchmark return, whatever we are getting. That is what is associated with asset allocation. Whereas when I am looking at the actual performance of the portfolio over this asset allocation mechanism is what is attributed to the selection. Selection is more specific within the asset class, identifying the mispriced securities, identifying the subsectors, and then trying to invest in those things. And at the same time, if this number is higher, then it is the security selection which forms a very important aspect, whereas if the asset allocation or the R squared is coming out higher, it is an indication of the asset allocation mechanism which is much more rigorous compared to the other. It even indicates, whatever this equation, it indicates the style specific to a manager. If this coefficient is very high, then it's an indication that majority of the investment of this particular manager comes into this particular type of strategy or style compared to the other styles. So that is how we can even use the regression analysis to assess the styles of the various funds. Alright. So this is what is a brief overview on the portfolio performance analysis. In case you have any further queries regarding this, you can get back to me by giving me a call on the number that I have provided below, or you could even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.